Hey, what's up, everybody? It is Monday, April 25th. Tomorrow's my birthday. All right, folks. So we had a little bit of a bounce back today. Not much to talk about, really. Elon Musk now owns Twitter. He paid $44 billion for Twitter. It's a company that is not profitable. It has about $3.5 billion in revenue. Somebody said that's about the size of Olive Garden. But he paid $44 billion. I don't know, maybe he could turn it into a profitable company. Maybe he turns it into like an open source thing that is not censored. I think that's really what he's going to try to do. And so that's good. That's good. Elon Musk bought Twitter today. Look, we had a little bit of a bounce back in the market today. Like I said, I don't think much is going to happen until we get the Fed's first rate hike on May 4th. All right? I mean, everybody is freaking out about that. As I've been talking about, the sole focus, it's like a micro intense focus is on interest rates. Everything else is being ignored or rationalized as being not important. You know, monetarism, as I've said many times, it's a mental illness. I mean, it's been a mental illness for 40 years, but it has now gotten to a point where it's a psychosis. It's really sick. That's when it comes to the financial markets, when it comes to any kind of analysis, economic analysis, that is the sole focus. I mean, if you watch me, I'm the only guy who talks about fiscal. I'm the only guy who talks about fiscal flows. If there's ever any mention of fiscal, it's in kind of a broad brush stroke. You know, people just saying, oh yeah, we had a stimulus. But I mean, I break down the numbers for you in my report. By the way, today's Monday. The new issue of MMT Trader is out. Let me reiterate, folks, I am the only one who has an applied approach to MMT. I take the concepts and understandings of MMT and I use that and I help people. I show people how to use that to trade and invest properly in the financial markets. It's not a short-term trading approach. It's a macroeconomic approach. It uses the understandings and the concepts of MMT. In other words, the real concise understanding of how the monetary system functions. All right, if you want to get a copy of that, if you want a 30-day free trial, I've now posted up on my website, pitbulleconomics.com. There is an individual subscription rate of $195 a month. You can go there, you can get a free trial and check it out. Let me mention something here. I'm going to go over something that I explained on Friday, or I read to you on Friday, and I think it's good to repeat this because in the backdrop to this panic we are seeing, this frenzied selling in the stock market because, you know, the Fed's going to raise rates by 50 basis points and we had 10-year yields, you know, back up to the highest level in 2019. That's not that long ago. I mean, 3 years ago, that was considered like totally normal. But everybody is freaking out. And again, if you look at a long-term chart of interest rates of the 10-year yield, I mean, you know, there's nothing to talk about. I mean, it's been a steady decline. And so we've had over the last year this rally in bond yields. And yeah, inflation is high, and I still think that actually, I think we were seeing some relief in the inflation picture before the Ukraine war started, and then, you know, billions upon billions of sanctions, thousands of sanctions, you know, blocking oil, blocking fertilizer, and that's just, you know, we're at a point where we're starting to see some relief. And then all these sanctions, and that's just really, really bad policy by the United States. The United States just wants to prolong this war. It wants to do everything it can to weaken Russia. And the irony now is that the ruble is stronger now than it was prior to the invasion. So I don't know who's, you know, losing out. I think we're losing out more because you see the hit the financial markets are taking because of people panicking about rates going up. But anyway, what I'm saying is that in the backdrop, I spoke about this on Friday. You have we have a blistering acceleration in bank credit. I mean, let me go through some of the numbers here. Loans and leases. This is for the week ending April 13th. Loans and leases were up 63 billion. It was the third week up. It was the biggest increase in 25 months. The loans are growing at the fastest pace in 20 months. I'm reading this off of my phone. I sent this out. This was an email I sent out on Friday, but I'm reading it to you. Commercial and industrial loans, right? Which is like a barometer for business activity, inventories, capital investment, this kind of thing. Commercial and industrial loans increased 30.4 billion. It was the third week up. It was the biggest increase in 2 years. Now, what's interesting about these loans is they've been in a contraction year over year. In other words, they've been declining year over year for the last 13 months. But now they're just about even year over year, and very soon they're going to be growing year over year. So the trend is definitely improving here in commercial and industrial loans. Real estate loans, like everybody's saying, real estate is dead. It's in trouble. Real estate loans are up 10 weeks in a row. All right. The growth rate now is the fastest in 62 months. Now, some of that might be due to rising prices, right? If home prices go up, you obviously have to take out a bigger mortgage. And that's going to reflect in the growth rate of these loans just because the absolute amount is going to go up. But still, very positive. Residential real estate loans up again, the highest in 24 months. It's been up 10 consecutive weeks. Okay? Commercial real estate loans at an all-time record high, up 14 consecutive weeks. And it's growing at the fastest rate in nearly 5 years. Consumer loans, look, I could go down, growing at the fastest rate in 13 years. That includes credit card and revolving credit, and also automobile loans are growing at they're growing at the fastest pace in 8 months. So look, bank assets were up 65 billion. That's a record high. It's the third week up for an increase of 213 billion in 3 weeks. Bank residual, which is literally bank net worth, it's assets minus liabilities, that increased by 14.5 billion. That was the biggest increase in 7 months, and it was the third week up for an increase of 60 billion in residual. Residual is like capital, so I mean, 60 billion times 10 is 600 billion. That's 600 billion of new loan capacity. All right? All right. So, like, if things were really shitty and things were really going down, don't you think you would see a contraction in bank credit, in demand for credit? Look, 3 things go into bank lending. Number one, okay, you have to have borrowers who are credit worthy. Credit worthy means they have the capability of borrowing, which means they have the income to pay the loan, and they have a balance sheet which is not too loaded up with debt. All right. Number 2, there has to be business opportunity. All right. You see commercial and industrial loans going up. There has to be demand for credit. All right. Like people, if there's no opportunity or people don't want to buy or invest, there's no demand for credit. So there has to be demand for credit. And number 3, the banks have to have the ability to extend that credit. What do I mean by that? They need the capital. I just showed you that they just added 60 billion in capital. And what we saw recently, and I talked about this on Friday, we saw in the week ending last Wednesday, the biggest 1 week decline in reserve assets, bank reserve assets, ever. 467 billion. By the way, you don't hear anyone say, they're unprinting money, they're unprinting money. They only talk about printing money when the reserves go up. And it's only when the Fed does it. You know, it's not just the Fed that could impact reserve balances or money printing, right? It's also fiscal. Nobody talks, they only get all freaked out and their feathers in a ruffle when the Fed is doing something. That's the only thing they understand. And it's again, it's this kind of monetarism sickness, this psychosis, this mental illness. They only talk about it when the central bank, but here you have almost a $500 billion decline in bank reserves. Like that's sucking the money out. That's money unprinting. Nobody says anything. Nobody questions how that happened. It happened from tax flows. I'm going to talk about tax flows in a second, because if I have one concern right now, it's about tax flows. Tax flows are at record levels. Government's collecting record taxes. Actually, right now, total federal tax deposits are up $635 billion over where they were at this time last year. I mean, that is a number that is like in the stratosphere. We have never seen a year-over-year increase in tax collections, $635 billion. So, I mean, that's a crazy, crazy number. I mean, total federal tax deposits right now, like, I think they're like 3.1 trillion compared to like 2.5 trillion at this time last year. So 600 billion over. So that's what sucked out those reserves. Everybody had to pay taxes. I mean, it's like, that's a problem, because that right now the deficit, and what's the deficit? The deficit is net government spending. That means everything the government spends minus everything it takes away in taxes, and that's what's left for us. That pot of money, you know, that's our dollar savings. That pot of money, that's our stock of savings. And the deficit now is down 1.1 trillion compared to last year. So Biden has already reached, he was bragging about, remember I was talking about this back in January, how the deficit was shrinking, and Biden was like going out there making speeches about how this is going to be so great. You know, I'm the only guy who's going to reduce the deficit by $1 trillion in 1 year. It's already done. It's already done. The deficit right now is like 580 something billion compared to like 1.7 trillion is where it was last year. So like, let's call it 600 billion now, the deficit. Last year at this time it was 1.7 trillion. 600 billion of those financial, that stock of savings taken away. That's a problem, okay? I'm not saying it's an immediate problem, because as long as these monthly flows stay up there around 600 billion, I think we're going to be okay. But that is a huge problem. Like, he just reduced the deficit and he's bragging about that. But look, if we go into a recession, and now I would say the odds are a little bit higher. I'm not calling for one, and the main reason I'm not calling for one is because I think right now bank credit is going to support, you know, consumption and investment. But like I've said in past videos, you know, that's limited. It's limited by those three factors I talked about last time, like, you know, demand for credit, credit worthiness of the borrower, and capacity of the banks, or ability of the banks to extend credit. So right now, luckily, household debt service burdens are very low still. So I think it could go on for a while. But this shrinkage in the deficit by $1 trillion, over $1 trillion, that's not good news, all right? In fact, it's terrible news. So we got to be monitoring these tax flows. We got to be monitoring what's happening with the deficit. Anyway, that's my update for today. Go get my report. There's a lot of good stuff in there. Folks, if you don't understand MMT, or if you understand MMT, even if you understand it and you're not applying it, like, you know, science, we need science, but then we need applied science. We need to take that science. That's why we have telephones. That's why we have airplanes. That's why we have, all technology that we turn into useful products for our lives to advance our standard of living, modernize. I mean, take the MMT concepts, learn how to use them to invest. Go to my website, www.pitbulleconomics.com. Sign up for a 30-day free trial. Bye.